I'm Dr. Jonathan Surton, CEO and President of Axiom Space, and you're watching Taking Stock.
Further opportunity.
2 minutes to go here into the closing bell. Welcome one and all to what is always our favorite time of the day down here on the trading floor of the New York Stock Exchange. Welcome to Taking Stock. I'm JD, that's Peter Tuchman. Peter Tuchman, yes. We are pretty notably off our session lows in the S&P. Nice reversal for NVIDIA. Yeah. That's a big concentrated name. Overall, obviously, what did you see on today's tape?
You know what, look, it was sort of hard to really gauge what's happening today, but it appears from the tape that the buyers are being patient. They're letting the market come to them. Right now, with the markets trading pretty frothily, you know, at these record highs across the board, I mean, it's in their hands. The market's in the buyer's hands, right? The sellers are not here aggressively because there's no particular reason to sell it. So basically, and the buyers are looking to try and accumulate some positions here just for the long term. They don't want to have to play catch up coming into the end of the year as we saw last year. So they're looking for their spots. As you see, when you see that kind of reversal, it can be NVIDIA's reversal from trough to peak, but it can also see buyers are sort of waiting for the sellers to come to them. We've been seeing that also, just rotation, right? We're seeing 50-50 on, you know, advances versus declines, and that shows that, I mean, these are fundamentally good days. You're not seeing heavy buying, heavy selling. You're just seeing people patient on those guys.
And a reminder, we're not out of the woods in terms of a ceasefire. We got that awareness today.
But the market's not focusing.
Oil up and stocks down. Peter Tuchman, thank you for being here to kick things off. It's nice to see you. The team from First Eagle Investment set to do the closing bell. Time now for the close. There you have it. The three gavels have been struck, which is always my cue to start talking. Once again, your final tail of the tape on this. What is this? Wednesday, July 8th, the S&P 500 in the red. Let's call it 0.3%. The Dow, the hardest hit of the major market indexes, in negative territory, a clean percent. The New York Stock Exchange Composite Index, not very far removed from all-time high after all-time high, but today, down 0.95%, and the small caps down, let's call that 9/10. Not a ton of buy-in across the tape today. I mean, Peter Tuchman and I a moment ago talking about that big reversal in the afternoon for NVIDIA. Given that it's so heavily consolidated in the S&P, that helps explain kind of the reversal in the S&P. I mean, we're finishing well off those session lows, which are from earlier today. Let's call it the 11 a.m. hour. Energy and tech, the only sectors in the S&P 500 in the green today, and a fair bit of selling. Materials, discretionary, both down about 2% on the day. Financials and real estate hard hit as well. Only a handful of stocks in the Dow itself even in the green today, but some outperformance in the afternoon from NVIDIA, Walmart, as well as Cisco, a handful of other defensive names, and your Dow laggards, Amex, Sherwin-Williams, as well as Boeing, Tesla, and Google, the hardest hit among the Mag 7 tech stocks. Let's bring in the one and only Hartika Singh of Fundstrat. She is, of course, one of our favorite guests here on the show. Nice to see you again.
Nice to see you too. It was just last week, right?
It was just like, yeah, to be fair, a lot of the days tend to blend together, but they're always very grateful for your time. Okay, let's just take a look up here at the big board. I mean, markets overall, obviously not at a round of all-time highs, but we're not very far removed from those fresh records. What have you seen most recently? Anything surprise you or jump out in these markets?
I think the prospect of ceasefire no longer being on the table really spooked markets today. And it's weird because for the longest time, it kind of just didn't matter what was happening with it. Investors had already priced it in. They had moved past those worries of war. Oil prices started to come down, you know, they're back to pre-war levels for the most part. But then we had today, and it sort of just stripped things up all over again. I think today, given the stock market reaction, we had a little bit of a sell-off, but it's not big enough yet for me to be concerned about it and start thinking, oh, these are not levels where I would buy the dip. At these levels, I would buy the dip here.
Yeah, we did have a few sectors that did do pretty well, or tranches of stocks. Oil and energy stocks did well. Most of the semiconductor names like Broadcom did very well today.
Yeah.
Memory did very well, though the quantum names, a lot of these high-flying, the high-beta stocks kind of reversed. But otherwise, you look at airlines, the banks, fintech, the home builders, A lot of sellers were a lot louder today on Wall Street today.
100%. And I think the other stocks doing well, it just goes to show how important it is to have a diversified portfolio right now. We've all been so heavyweight into these tech names, these high-flying memory stocks, Micron, SanDisk, and I think somewhere along the way, for value of holding financials, industrials, healthcare. You know, these are stocks that are doing well because of the rotation trade going on right now. I think I saw a stat that the Dow Jones Industrial Average finished June. It's best June compared to the Nasdaq since 2022.
Wow.
So that's pretty impressive. I think that Dow being price weighted, not having as many tech stocks, doing well goes to show that diversified portfolio still has a role right now.
That's right. We talk a lot about Goldman Sachs and Caterpillar being the outperformers in the Dow, and they are the most
100%.
weighted stocks as well, around $1,000 a share. What is one reality about portfolio allocation for the second half of 2026 on your radar? You think people watching might benefit from paying a bit more attention to?
I think that's a great question. I think we might have a little bit of a sell-off here going into fall for the most part, but I think we're still going to have a very strong year. I estimate, you know, Tom Lee, our head of research, he estimates it's going to be 8,000 points for the S&P 500, which is significantly higher than the levels right now. But I do think that the road ahead is going to get a little bit more volatile, especially as we've seen with the memory stocks coming down, right, in the past month. For me, I would say the biggest concern is the new Fed chair and Fed policy from here on out. The data is so confusing. We don't know what's going on with inflation. I thought it had peaked, but oil prices are rising up again today. So I'm wondering if it's worth changing that outlook again. Job market was strong, but then the last job report showed that, hey, it may not be as you could imagine. So I think there's a recalibration here that needs to happen. And the new Fed chair, that's just not a good combo for the stock market term. So I think eventually we do finish out very strongly here for the year. In the near term, it's a little tricky.
Speaking of Kevin Warsh, what do we learn,
Yes.
if anything, for Fed Minute today? I feel like, you know, we talk about Fed Minutes when they come out. Maybe it's kind of a muted reaction. I feel like today was an interesting one to see a little bit more under the hood about what a Warsh-led FOMC will look like, and maybe not total consensus among the voting economists on that panel.
I think the one big takeaway that I got from the minutes was that he wants to overhaul the Fed. The Fed, as we know, is just not going to be the Fed that is leading the new age. And I was a little bit concerned that there was building consensus on rate hikes rather than easing. But the fact that he has reiterated in the past that forward guidance is very important for him, I think that means, there's going to be lack of forward guidance. I think that means that we should be more economic data dependent. And what the data is telling us right now is that a pause is completely fine. We don't need to worry about hiking. We don't need to worry about easing. Let's just look at what the data is telling us. And according to that, I think it's a pause for now. It's a hold for now.
All right, the great Hardik Singh of Fundstrat, thank you for being here. And thank you
Thanks
for bringing
so
the
much.
Fundstrat intern to
Yeah.
me, by the way. Howard, can we show the Fundstrat interns? Give it up here today. Rock and roll. Thank you for being
Thank you
here.
so
As
much.
always, thank you guys for being here, one and all. Howard, here are a few of the top analyst calls that moved the tape this morning here on Wall Street. You may have missed. First up, BMO initiating coverage on Viking Holdings with an outperform rating. They say the cruise company's valuation, yeah, they say it's high, but investors should consider an entry point anyway. Price target $115 a share. Next up, Barclays initiating strategy as overweight, calling it amplified play on Bitcoin with leverage and BTC yield. Shares down 37% since the start of 2026. And finally, JP Morgan downgrading Ollie's bargain to neutral from overweight. They say there are concerns about a miss in same-store sales. Price target now gets lowered to $70 a share. Shares are in the red about 70% so far year to date. We'll take a look at shares of Bath & Body Works, talking about being in the red. This stock getting a downgrade on the day, and it's down just about 6%. Goldman Sachs now given it a sell rating on distribution risk. Analysts from Goldman say sentiment is trending below historical levels for BBWI. Shares today trading back down right about to its 50-day moving average. Shares of Bath & Body Works down 6% today, down year to date about 5%. The New York Stock Exchange's very own Kristen Scholler sat down with Helion CEO Thomas Healy. That conversation occurred recently at the All-In Liquidity Summit, and they discussed how the firm is helping to power the ongoing AI boom. Take a look.
We're here at the All-In Liquidity Summit in Napa Valley, California, and I'm pleased to be joined by Thomas Healy. He's the founder and CEO of Hyliion. Thomas, welcome.
Thanks for having me on. Great to chat again. It's
Yes.
been a little while.
Give us an overview of your company, Hyliion, and what it's doing today.
Yeah, so we do power generation. We've fundamentally actually invented a new way of making electricity, which is really cool and exciting. But as you think about data centers, as you think about the US military, they need more power. And we are a new way of producing electricity. You can feed it over 20 different fuels, nat gas, hydrogen, diesel, propane, and actually provide the electricity out of the system. Compact box that can go on site for distributed power generation. So it's this concept of make your own electricity.
Yeah, and I'm sure our viewers can follow your ticker symbol. The company has transformed over time. Walk us through that journey.
Yeah. Last time we spoke, we were actually an electric vehicle company. We were producing electric semi-trucks. And 2023 timeframe, we saw the writing on the wall. The industry was struggling. And we acquired a division out of GE Aerospace that was this power gen technology. We decided to pivot the company out of EVs into power gen. And that's what we're focused on now. And we've taken the company from at the low point, we were at about 100 million market cap, and now we're north of $1 billion and on this trajectory to really go disrupt power generation.
How would you describe the importance of energy today, especially when it comes to security?
Yeah, it's fundamental, right? Everything is based around energy and being able to power these systems, right? So as you think about AI, when it was kind of the hot topic, maybe 2 years ago is when it really started picking up. Everyone started focusing on, well, where are these chips coming from, and are we going to have availability of chips? That then went to a point now where companies are buying chips and actually storing them in warehouses, not even bringing them online because we actually have excess chips and we're lacking power. So now we're kind of getting to layer number 2, which is, well, how are we going to power all of these chips to really win this AI race? And the reality is we're not winning right now. So as you look at China added about 500 gigawatts of electricity generation to their grid last year. We added 50. So China 10x'd us last year, and this is what everyone's talking about, that power is who's going to win this race. And so we need to make a lot more electricity in this country.
What sets Hyliion apart in this space?
Yeah. So it's fundamentally just a new technology. We think it's the better mousetrap, the better way to do it. The grid right now is kind of a system where you have these big power plants and then they distribute out to all these end destinations. We think the grid is going to shift to distributed generation where you actually make the electricity on site. So you think about like this building behind us, it could have a power module right next to it, just like it's got AC, it can now have a power module making electricity. And we think that's the kind of path forward for data centers, commercial buildings, hotels, hospitals. And it needed a new technology though, and that's what we've been able to develop, where they're these small modular boxes. You can stack them together to get the amount of power you want, and they're low maintenance, they're high efficiency, they're fuel agnostic, so all the things that people care about, we've been able to bring forward with this new technology.
You mentioned that part of your conversations here are with potential strategic partners. What are you looking for in a partnership?
Yeah. So number one would be people to deploy and actually use our system. So as you think about like hyperscalers, they are the ideal customer for us. They're building out these hundreds of megawatts, even gigawatts type size data centers. They need power. Their mindset has shifted to they need to make the power on site because the grid doesn't have excess capacity in order for them to just tap into. So customers like that, but then also parties who are investing in this, right? This whole conference, there's a lot of investors here, and people are looking at, okay, well, now that we know that the chip side is happening and there's available chips, well, how are we going to build out that infrastructure around it? And so, showcasing what we're doing to those type of organizations who want to deploy capital into this space, and for us, that would really enable us to start scaling manufacturing at a faster pace.
How does the government factor into your growth story?
Yeah. So we have an amazing relationship with the military. It all started with the Office of Naval Research, so the US Navy, where they actually selected us as a power plant on board the new, we just announced it, it's the USX-1 Defiant ship. It's this 200-foot long, fully unmanned, autonomous ship, so there's no crew on board anymore, and the crew used to always maintain the engine, so they would go down and do oil changes in the diesel engine. now that the crew is not on board, they needed a new technology that was low maintenance. And that's one of the things that we really excel in. And so it started with the Navy, now it's expanded to looking at bases and actually powering bases. Even the Navy pulled in NASA, and we're looking at being the power system for a nuclear lunar program that NASA is working on. So even the Navy or the military as a whole is looking at this technology as really the future of power generation.
All right, Thomas Healy, always good to chat, and thanks so much for joining us here at the NYSE Media Hub.
Thanks for having me on.
Welcome back to the show. You are watching this Wednesday afternoon edition of Taking Stock live from the trading floor, rather, of the New York Stock Exchange. Our next guest joins us now, Corey Clipston, CEO of Swan Bitcoin. Corey, nice to see you here today. So, first and foremost, I need your take on Bitcoin price action. A lot of longtime holders out there, they're still sitting around saying, wait a minute, what is going on here? So to Corey, to you, I ask, what is going on here?
Hey, JD, thanks for having me on. And look, this is something we've been through many times before. And in some ways, this pullback, provably is a lot more shallow than previous drawdowns. And, think about 2022 or 2018. Those were much more severe bear markets. So if this is it and we bottomed out at 58K, that would be a big win for Bitcoin's continuing adoption, institutional adoption, just people's understanding of what it is. If these bull and bear markets just kind of get lower in amplitude of the big price swings, then it just is something that people can kind of count on in their portfolios and gain more confidence in. So, if we sit right here, we're fine. If there's a final flush down to, 53K or 49K or something like that, it would still be a dramatic improvement over the 77 to 85% drops we've seen in the last few bear markets. So not really concerned here. It's nice that we're kind of up off the floor, and I think over the weekend we saw 64K. I'm pretty optimistic that we'll see 70 something over the summer. We'll see. I think it's less likely than probably I thought earlier in the year that we'll see a new all-time high in the 126, 127 range this calendar year, but I think it's pretty likely we'll see that in 2027.
I mean, Bitcoin's been very range bound here for several months. You got a little bit of a newly formed resistance level, some new support. Is that a good thing to you, that the longer it can build that range-bound sideways action, that gives it a greater possibility in the future of moving up? Or are you sitting there a little bit eager, hoping for that move to the upside to happen sooner rather than later?
Well, look, to take the first part of that question, you can see it both in the data and you can feel it anecdotally if you're actually in the industry and just kind of gauging sentiment. Empirically, you can look at the data and you can see that the number of coins held in addresses that have had the coins for at least 6 months or at least 12 months are at all-time highs, which basically means that you're getting rid of lettuce-handed retail and lettuce-handed institutions that don't understand what they bought, and they freaked out, and it was just the new thing in their portfolio that they picked up in the last couple of years, and now they've sold it. And it's being transferred to the hands of people that that do understand it and like it at these prices. And this is exactly what set the floor in each previous cycle as well. So that is happening. I do think there's probably a good bit of resistance in the low 70s, around 73K. That was the high in March of 2024 after the ETFs launched. It was also kind of the bottom when there was a big run up to 108 or 110. Then it bottomed to 73 before running up to 126. So it's been both a top and it's also been support historically. So it feels like that's probably psychologically somewhere a lot of traders probably draw some lines. Again, if you zoom out and you're just a one-way buyer like I am and like all the Swan clients are, pretty much just buying every day or every week and just holding for the long term, having at least a 10-year time horizon, none of this really matters. But yeah, if you are a trader and you care about such things, I certainly would keep an eye on that kind of 73 level. And I do think it's very likely we kind of sideways chop and maybe don't punch through that until October or a little after.
Corey, I'm going to give you 10 points for use of the phrase lettuce-handed. Unfortunately, I'm out of time. Please come back. My best to the great John Haar over there. We'll talk to you again soon. Corey Clipston, CEO of Swan Bitcoin. Corey, thank you. Folks, don't go anywhere. A lot more Taking Stock coming up live from the trading floor of the New York Stock Exchange right after this. Welcome back to the broadcast. Our third guest of this afternoon's show joins us live here on the trading floor of the big board. John Miller, head and CIO at First Eagle Municipal Credit Team. Great to see you, sir. Thanks for taking some time for us today.
Thank you for having me.
Not just a great guest, but a guest who just rang the closing bell. First and foremost, your experience, you and the team down here, we had incredible enthusiasm. I feel like this is the dream for so many people in our biz, right? Whether you're on your side or my side, everyone wants to ring the bell. What was it like for you?
Oh, there's a lot of history, there's a lot of energy. It's just a fabulous place to be here.
Talk to me about First Eagle Municipal Credit, the work you do, your key priorities for anyone watching this interview who might be a bit unfamiliar with your core work and products.
Sure. Well, First Eagle launched municipal bond products starting in early 2024, starting with high yield municipals. We've raised approximately $10 billion in the last 2.5 years, outperforming benchmarks. Really, our goal is to create stable, high levels of tax-exempt income monthly across mutual funds, and now getting into the ETF market as well.
You know as well as I, you probably know far better than I do, that there's a lot of would-be investors or traders out there. They always see the headlines about the shiny things, the things going parabolic. Talk to me about the importance of municipal bonds for anyone out there looking to diversify their own portfolio allocations who might not really have given this particular asset class a ton of consideration up until now.
Yeah, it's a great point. Municipals are a nice diversifier to a balanced portfolio. They kick off tax-exempt income, which is increasingly important over time. It's increasingly important to affluent investors. Taxes are very unlikely to be going down anytime soon, and several states are also raising state-level personal income taxes. Many municipals are exempt from both. They also, as you alluded, don't have the same volatility characteristics and are not sensitive to the same drivers as equities necessarily, so you get that benefit from lower correlations. You get the benefit of diversification and general stability of your asset value where you collect the income.
And they've quietly been a big winner so far year to date here in 2026. What do you attribute that success to that we've seen in the general municipal bond space? And talk to me a bit about your outlook for the second half of this calendar year.
Well, I think a couple of things are very interesting about the first half. First of all, the muni market is in the midst of its third consecutive year of record high supply. So municipalities coming to market and bringing bond deals, issuing a lot of paper. When you combine that with changing Fed expectations, expectations around future inflation from the war and oil prices, you would typically see sort of a pullback, and that might be accompanied with outflows from funds that specialize in municipal products like ours do. That thus far this year we have not seen that. Actually, we've seen a continuous demand to place money into this asset class. That has created stability and a backdrop of liquidity and just overall income-driven performance. So the performance of products has been very highly correlated to income so far this year, with a relative stability in NAV, or net asset value. Outperforming, as you mentioned, outperforming, say, taxable fixed income or U.S. Treasury bonds.
Yeah. Very well done, and thanks a lot for taking the time to join us. John Miller, really nice to see you. Come back on the show anytime.
Thank you very much.
All right, folks, don't go anywhere. One more King Stock coming up live from the trading floor of the New York Stock Exchange. I brought you a cheer section for the show today. Thank you, John. Good to see you.
Thank you very much.
Welcome back to the show. Time now for a few headlines in the world of fintech, crypto, and artificial intelligence for your Wednesday afternoon. At this hour, the crypto majors all in the red. Solana, the hardest hit, currently down about 4.5%. Next up, tokenized equity trading hitting a record $3.86 billion in the month of June. It's driven by demand for blockchain-based SpaceX shares following the company's IPO. Finally, Reuters reporting Chinese AI startup DeepSeek developing its own AI inference chip. Yeah, remember DeepSeek? In doing so, set to join OpenAI, Google, Amazon, and others in the race to build custom AI hardware. Money 2020's very own Scarlett Sieber is now back to explain all of the ways that fintech companies actually make their money. Take a look.
Welcome back. I'm Scarlett Sieber with Money 2020, and on this segment of how fintech companies actually make money, we're going to be breaking down Currency Cloud, a company quietly powering global money movement. Currency Cloud provides embedded FX and cross-border payment APIs used by banks and fintechs worldwide. So how does Currency Cloud actually make that money? First, well, not surprisingly, FX spreads. That is the core engine. Second, API and transaction fees. Third, volume compounding as customers scale internationally. So why now? With more companies expanding globally and regulators scrutinizing cross-border flows, Currency Cloud's value isn't speed, it's correctness at scale. Let's say that one more time, correctness at scale. So Currency Cloud doesn't market to consumers, it sells the plumbing. And that is how Currency Cloud actually makes money, by earning on global money movement 1 basis point at a time. And that adds up, my friends. If you have another fintech that you want broken down, you know where to put it right here in the comments. In the meantime, back over to you.
Tomorrow morning here on Wall Street, the latest quarterly results from Pepsi, weekless jobless claims at 8:30, and existing home sales crossing the wire for investors to digest at 10 a.m. Thank you for watching today's edition of Taking Stock. Have a great Wednesday night. We'll see you again tomorrow.